Are we on the cusp of a big commodity trade deal with China? That's the question we'll discuss this morning. Good morning. This is Arlan Suderman, Chief Commodities Economist at StoneX. It's right now a little before 9 a.m. on Wednesday, July the 16th. And as we look at the update on the tariff war, where we stand with China, and I want to step back a little bit and take a look at things. We've had some comments made here recently about the relationship with China and whether we're moving toward a deal. And that was moved a little bit further yesterday when U.S. Treasury Secretary Scott Bessent commented that we don't need to worry too much about the August 12th end of the 90-day pause or rollback, whatever you want to call it, of the reciprocal and retaliatory tariffs. That deal was reached on May the 11th in Geneva, Lake Geneva, and then another deal was reportedly made a couple of weeks later, and whether it's a deal or not has been the subject of debate. Some would say it was a clarification of the May 11th deal. Some would say it's a new deal. But overall, nobody seemed to want to talk about it. Nobody wanted to seem to give the details on either side. And I speculated at the time that's because both sides gave up what they didn't want to give up. They didn't want to have publicly discussed what they gave up. And that looks to be the case. The so-called deal opens a 6-month window, according to industry reports, for rare earth minerals and magnets to flow to the United States for auto production. But there are indications that many other uses are still being restricted, likely including military use. Now, that's not going to be talked about. Rare earth minerals and magnets, China controls 90% of the world's processing of these. First of all, they came in with the cheap labor, made it cheaper to do, and the rest of the world basically said, environmentally, this is not something we enjoy doing in our borders. It's a dirty process to mine and process these minerals and magnets. China can do it cheaper, so let's let them do it. So now China has control of 90% of the world's supply via mining and processing. And these rare earth minerals and magnets are now an essential part of our economy for everything from the production of phones to cars to, maybe more importantly, military weaponry. And so some of the high-tech weaponry that we have today that we've seen on display recently, and I've talked about this previously. Now, that's not going to get talked about because neither side wants to talk about where their limitations may be militarily. But China has been restricting the movement of rare earth minerals and magnets, not just to the United States, but to much of the world, but particularly the Western world, because they can use this as leverage to get deals very quietly, to get countries to do what they want to do. So that brings us back to the United States and the trade war that President Trump has initiated with China, finding out that we need those rare earth minerals and magnets. But China also needs something. It needs the high quality chips like what Nvidia produces and others. And so back when this deal was announced, but neither side really wanted to talk about it again, I said, well, maybe that's because both sides had to give up what neither side wanted really talked about what they gave up. And the United States needed their rare earth minerals and magnets, and China needed those advanced chips that we can provide that they haven't been able to develop themselves. And that now appears to be the case. They are allowing the rare earth minerals and magnets to flow for restricted use in the United States, keeping our auto industry and possibly some others in production. The auto industry had some lines of vehicles that were ready to shut down, very close to shutting down because of the shortage. But Nvidia is now indicating that they're allowed to send their chips to China once again. And so that appears to have been the culmination of the deal. Now, I mentioned about Bessent's comment about not worrying about the August 12th deadline of the pause in both sides, U.S. rolling back its reciprocal tariffs and China rolling back its retaliatory tariffs. That's basically because both. I don't think that either side means that we're close to a big deal, but it does mean that each side has learned of their dependencies on another in certain sectors, like what I stated. As such, we will likely see more agreements involving those critical dependencies while continuing the overall trade war. Are energy and ag commodities among those dependencies? That's what the commodity world wants to know. And I would argue that neither are considered in those categories. Now, energy could become one of those dependencies if President Trump were able to be successful in his sanctions against Russia and stopping Russian oil flow as a result of the Ukraine war. But that's going to be very difficult to do. As for ag commodities currently, China can get the soybeans it needs from Brazil, Argentina, and a few from elsewhere, plus its reserves. It can get its corn from Brazil, Argentina, and Ukraine. It can get its wheat and canola from other countries. So it doesn't need to buy from the United States if it doesn't need to. So I am not holding my breath for a big deal for ag and energy commodities that would benefit the United States at this point. Now, that begs to ask the question, how is China's economy doing amid this trade war? Yesterday, we saw China report solid GDP growth. This is government numbers at an annualized rate of 5.2% for the second quarter. Now, it's a bit lower than the 5.4% in the first quarter, so that gives us a 5.3% rate for the first half of the year. That means that China theoretically could have a slowdown in the second half of this year and still hit its 5% goal. The government reports that consumer spending drove 52% of that GDP growth in the second quarter, following 51.7% in the first quarter. Exports were the second largest contributor to the solid reported GDP pace at 31.2%, although that's down from 39.5% in the first quarter. Now, I remain skeptical of these government GDP numbers, and here's some of the reasons why. Historically, we see a strong correlation between GDP and growth in electricity output, but that increased by just 1.7% in June, and it rose by just 0.8% in the first half of the year. China's property market is also one of the core components of its economy, and it continued to depreciate in June, with new home prices falling another 0.3% on the month of June after falling 0.2% in May. Nearly all 70 Chinese cities that are reported to track housing prices saw growing downside pressures in home prices in June as the property meltdown continues. China did see retail sales up by 4.8% year on year in June, but that was largely driven by China's massive stimulus program that subsidizes the purchase of certain consumer items. Those items are moving at this point, while the non subsidized items are not. These subsidy programs continue to drive China's fiscal debt levels to new highs when added on top of all of its other stimulus measures. Now, one other thing that I wanted to discuss this morning, and that's something I've been mentioning, even though the corn condition ratings are high in the United States, suggesting high yields somewhere in the mid 180s bushel per acre range currently, that gives a snapshot of the current yield potential of the crop. But I've been saying, take that with a grain of salt, because I'm seeing reports and seeing pictures of pollination issues at various places across the southern half of the Midwest where we're far enough past pollination to be able to detect it. This doesn't fit with the weather. Now, there's some excuses being given about the whorls being too tight to holding the pollen in, not allowing it to reach the silks of the ear, etc. As a past agronomist, I'm skeptical of that. I don't believe it's that, but I can't tell you what it is at this point. Nonetheless, pay attention to what the scope of this pollination problem may be. In some areas, we're not seeing it. In other areas, we are. And it seems to be across a wide variety of hybrids, but not all hybrids. So it depends on what mix of hybrids is popular in a given area. So it's something to keep an eye on. How much impact could it have on national production is still too early to know, but I do believe that is one of the factors now beginning to make fund managers with large speculative short positions nervous, resulting in some short covering. Is it enough at this point to justify sustaining a rally? I don't think the evidence is there for that yet at this point, particularly with the U.S. farmer and the Brazilian farmer very undersold at this point. But it is something worthy of watching, particularly since the funds do have such large short positions. I'll continue to keep you updated. And that's today's report from the trading floor. I wish you well, and I'll be back with you later this month after a return from some travel. Thank you.